Right, guys, welcome to this live chat. Very happy to see more than 70 already here. Appreciate you waiting in line, so to speak. Quite a lot of questions. I see some people are a little bit worried about my headline. So let's get straight into it to calm nerves and get straight to the juicy bit here. As always, bear in mind, guys, this is for entertainment purposes only. This is not financial advice. Let's get straight to it. Some news out today here. This is a translation of a Chinese article, as always, that the anti-monopoly investigation. So that's the one into Alibaba Group. This is separate from the Ant Financial Alipay investigation. The Alibaba Group investigation essentially based on this forcing vendors to choose one of two platforms in one way or another, whether it's for the whole shop or products or special offers, as a lot of you might be aware. Now, the anti-monopoly law in China apparently has a maximum 1% to 10% penalty range based on last year's sales, so last year's revenue. Now, Alibaba's last revenue as of 31st of March 2020 was for 509 billion renminbi. Therefore, the maximum fine equates to 51 billion renminbi. That is, let me ask the calculator, 51 times 0.15. That is, I don't know if you can see that, 7.65 billion US dollars. That appears to be the largest fine Alibaba Group could face. Now, is that good news or is that bad news? Well, it's a substantial sum. The largest fine previously dished out by the Chinese regulators was about $1 billion US on Qualcomm in 2015. Some of you might remember that. That was at the time the largest fine ever issued. Obviously, Alibaba Group, a much bigger beast, a much more substantial company. And my take on it really is, if they get away with a fine on this, it's probably a good outcome, especially if it comes quickly. If we get this fine coming up very quickly, Alibaba Group has 50 billion US dollars in cash. So for them to pay 7.65 isn't really going to impact anything in particular. I don't think it would particularly impact valuations, even because that tends to be done on cash flow forecast or future earnings for a growth stock like this, rather than how much money they have in the bank. So I think that would actually be quite a positive outcome, especially if it comes quickly. Right, guys, are there any questions? Why would you fine sales and not net income? I don't write the Chinese laws. A lot of anti-monopoly laws around the world, the fines are intended to be potentially very large. They want to set a discouraging objective there for their fines, so you can fine on the basis of revenue rather than profit. So why do you do that as a lawmaker, as a government? Well, you do have growth companies that could be very substantial, have large sales but don't make profits yet. Look at Amazon, for example. They were negative numbers for many years, except for that one quarter where they always show us what they could do if they wanted to. But fast-growing companies often write losses for many years. If they were then behaving in an anti-monopolistic way, if the fines were part of profits, well, you couldn't fine them. So these kind of fines are typically based on revenue, and therefore they hit much harder. So thank you for that, Javier Lopez, for that question. Chan Yili, when will the verdict come out? That's unfortunately something we don't know as yet. Now, I certainly have been very surprised by the speed of this whole investigation. If you think that this only got kicked off on Christmas Eve morning, we have gone through quite a lot of information in detail on all of this, really. And we are not provided yet with any kind of definite to this, though we have seen on the Ant side, for example, where the regulators has basically said, look, the investigation is more or less over. We've been there, we've seen everything. They were cooperative. So and they're now waiting for the company to put in place the things they asked them to do. So I do think that the government is wary here of the damage they are doing to the standing of Chinese stocks internationally and to the financial market, and they want to get this done quickly. there are other aspects to this which will take time. The fintech regulation, new laws being passed around that sphere, that will take time, and that one might well take most of 2021, possibly even somewhat longer. So I think those people who are hoping for a new IPO date for Ant very quickly might well be disappointed, in my view. Where's Jack Ma? Any truth to the rumors? I think he is very happy, and he is in a mansion somewhere in China, and probably talking to his lawyers and his exec teams and his regulators, and trying to figure out what to do with his controlling stake in Ant, and how to come to some arrangement there with the regulators with this whole structure. And that's really the next major piece of news we are going to look at, which is, I think, equally important. I know some of you and some commentators are saying Ant isn't really a big part of the Alibaba Group. It's only, at the time of the listing, was 100 billion. That stock was worth, those 35%. So if you discount that, it's not actually that important, and it doesn't provide revenue as yet. But I would say that anything Alibaba and related drags the whole Alibaba name down. We saw it with the Alibaba health stocks in Hong Kong, for example. They went down 10% for no particular reason, just because the whole group is lumped together. Anything with an Ali or with a Jack Ma in front does seem to be dragged down by this. So John Stamos, why the dislikes? FFS, well, guys, you are very much up to you. I would appreciate if you enjoy these updates live from Hong Kong daily here for free for you guys. I dig out Chinese information and what's going on and rumors from the market. Hit the like button. It helps me a great deal with the algorithm, and more people get to see it. If you don't like it, well, I can't do much about that, but I do appreciate your feedback. John Stamos, thank you for your kind comments there. Ishmit Bajaj, also very much appreciating your always tuning in to all the lives here. There are more than 157 of us live here, only 17 likes. So I would appreciate the 130 rest of you to hit that button, and I will provide you more information, and I'll be incentivized to give you more information more frequently directly here from Hong Kong. Now, this is an article here I think we like to go through. It's a little bit detailed, but it tells us quite a bit about what is happening to Ant. It tells us what happened to their loan book, and that headline I put up there, that takeover, it was loan book takeover before, but it was just too long to fit it in this space. So apologies if that clickbait got your juices going a little. Basically, the loan book has been moved, and I'm going to get to why and how. So here is another article out just in Chinese. So excuse if you're reading this English language here. It is a little bit Chinglish, if you will, courtesy of the translation. So what we're looking at here basically is, just go back a step, largest IPO in the world was stopped of Ant Group, and then now there are changes to be made to the structure of Ant Group, and not everybody understood the, I think, breadth of the width of that Alibaba financial services company, which is really the Ant Group. It isn't just Alipay, this payment provider, but it's the largest money market fund in the world, and that comes from the lending that they do. And I'll explain again how that money goes into a money market fund and how that got them around the banking regulation, and that's part of the reason why this IPO was stopped by the regulators. They are also the largest insurer in China, and undoubtedly the largest broker of financial services in the country. And of course, they have the blockchain technology. They basically power the credit rating service of the Chinese government. They are in everything. This company really underpins so much of the Chinese economy that it isn't surprising that regulators are honing in on it and feel that they need to come up with a regulatory framework. We saw the financial holding company law come in earlier last year, I should say now in 2020, and that's where we have this holding company coming up. So we're going to run through this as quickly as we can to give you information of the updates here. A couple more questions here. Do you think Alibaba will get split? Alibaba Group, I would say no. That would be my view. I mean, it's always just my view. and financial. That is really the question here, and we're going to go into that. Is everything going to go into this holding company, or will part of it, perhaps just the payment service, stay out of it? Are they going to keep the insurance side with the financial side? It is all very interwoven, so it is difficult to separate it, because that's how Alibaba has grown. Everything is linked. Everything provides services to other parts of the Alibaba ecosystem. Rudy Hang there, thanks for joining. Well, let's overshow their earnings, which will be out in early Feb. Look, we have to just wait and see a little bit of how quickly this moves. This has moved incredibly quickly in the last, 9 days or so. So it is possible China does move at very, very quick speeds. It's possible we have a more resolution there, certainly on the Alibaba Group side, and also perhaps more on the structure of the Ant side. But positive earning numbers are always a good thing. They might well surprise us there, because I think they've had a very good quarter. Norina Doni, with the 3 Chinese companies being topped of the NYSE fine in the new year, how do you expect Baba to go down? I covered that separately, really. I think that is a negative sentiment. I think that is a bad news story for Chinese stocks. It isn't a good news story for anything China related, although Baba, of course, isn't directly affected by that, because that's very specifically targeted at those 3 telcos. Guys, I will get back to your questions. Let's run through some of this information for those of you who've been hanging around since the very beginning. Appreciate the 52 likes, guys. There's still 120 of you, though, who are reluctant to press that thumbs up button. Perhaps that's something we can change. Now, Ant basically has a lot of hidden risks and loans. That's what they kind of discovered. And the risk of financial contagion is really what the government here is afraid of. So here is a Shanghai law firm, Dong Yiqi, a Chinese lawyer, who's commenting, and he's saying, in addition to the platforms business, so this is the anti-monopoly, forcing people to give Alibaba's platforms, Tmall, Taobao, better deals or exclusive products or even exclusive brands and shops. That's one issue. The second issue is Ant's future, and that will also involve the actual controller and equity structure. And if you've been following me the last few days, the actual controller is Jack Ma. Jack Ma controls 50.5% of Ant Financial, not directly through shares, but there are 2 holding companies above that own the 15.5%. And then above that, there is another holding company that owns those 2 companies. And in that, he has a 22% share, if I can remember correctly. But his voting rights are special, so he can outvote the others, basically. His votes just carry more weight. So in effect, even though it isn't that obvious to start with, in effect, through the way the articles of that top company are set up, he controls the 2 subsidiaries which have more than 50% of the shares of Ant Financial. So Jack Ma personally is the ultimate controller of Ant Financial. That is something the regulator is not comfortable with. From the rumors we've been hearing and the commentary we've been hearing, we expect that to change. Now, Jack Ma didn't intend to hold on to that equity. If you read the annual report from 2019 and the information pre-listing, he was intending to reduce that stake to 8.8%. by giving away his shares to employees. So an employee incentive scheme, very unusually financed by the owner. You don't normally see that. Normally companies issue new shares for employees and therefore dilute shareholdings. And then secondly, there was an intention to dilute shareholdings through subsequent issuance of shares. And so therefore, it isn't that difficult, I think, to get Jack Ma to part with his shares. The question is where are they going to go? We know that Ant Financial has been in touch with some private equity houses here in China to divest some of the non-core holdings. They have lots of things they own, from shares in Didi, the Uber of China, to the bike sharing companies, fairly random things. Why did they invest in those? Because those companies then use Alipay's payment services, and the back end, the sort of operating system of these companies is then powered by Alibaba software. So this has been an Alibaba growth model: buy into fast growing startups and kind of make them part of the Alibaba ecosystem. And I don't think it's that unusual. You don't normally have insurance companies, banks owning that kind of investment in the same legal entity. If they do have such investments, they have a separate investment fund that falls outside of the banking and insurance regulation. So he here confirms that he believes there will be actual controller and equity structure changes, and they'll reorganize the management and the shareholders so that the business is compliant and it can suitably be reinstalled into an entity that can then be listed easily. So this listing is still very much on the horizon of the new Ant Financial, but it will likely be a new company. It might well be that holding company that they set up over Christmas, and I would expect them to put the financial lending side into that, the insurance business into that, the money market fund into that. We have yet to see whether the technology that actually handles the payment, which is basically Alipay, whether that goes into that or whether that technology company stays outside of that. And that's really what we're going to get to here again with some more detail. So the main body of the future listed company will still be Ant's core, I believe, their financial services, insurance services, but it will have to fit into the standard model of a sort of bank or insurance company. I think this hybrid of the reason I think really Ant didn't separate itself before is because they wanted to get listed on the tech board, on the sort of NASDAQ equivalent. They wanted to be viewed and rated and valued as a high growth tech company rather than a bank. So the valuations for that would be more favorable than if they were a financial services company, which is quite frankly what they are. And then it gives us some examples here of where there's some M&A between Chinese banks and where the core banking business was taken over by that new bank, and the non-core business, like the insurance businesses, were spun off to other entities. So it's an example of the regulator saying you're a bank, you're not an insurer, therefore it should be separate. So here it says 2 people with direct knowledge of the matter revealed on Tuesday that Ant Group is considering incorporating most of its online financial business into a holding company, including consumer loans, wealth management and insurance distribution business. So this is that insurance sort of brokerage business I think we're talking about, as well as all its holdings in merchant banks, because they actually have some equity holdings in Chinese banks also. So this would be a banking service with a bit of an insurance arm. And if you look at a company, for example, like HSBC here, one of the major banks here, they have quite a big insurance business. So those kind of things can fit together, although whether that's all in one company or not, or through a set of subsidiaries that then have separate regulations, we have to see. Now, the central bank basically said that Ant Group has substantial controls over securities and insurance companies, and that they might need to essentially set up a holding company, and their financial activities must be fully integrated into a regulatory framework. And we know that Ant has set up that company, but we don't quite know exactly yet what they're moving where. It's uncertain whether the payment business will be included. So Alipay, which is this payment system we use on our phones here, you can pay literally everything and anything with it. And especially in mainland China, there are a lot of shops that don't take cash anymore. You can pay with Alipay or with WeChat Pay, and that's it. So you have to have one of the two. Most people actually probably have both on their phones. And we've also seen the Alipay no longer has money in it. You can no longer make deposits into Alipay, because then there would need to be a bank, and they're not. And Alipay have encouraged that in the past, but that's a fairly flagrant breach of banking regulation if you don't have a banking license. So now I've also looked at it in my phone. It just, because it's linked to your credit card or to your bank account, so you pay for something, it just takes the money rather than holding a deposit, for which Ant has in the past paid quite high interest because they wanted to get money in there. So it says here the third-party payment system has experienced a broken direct connection, and 100% of the reserve fund has been handed over to the central bank. So that's interesting here, and we're going to get into that these funds there, and I think also a lot of these joint loans, as they were called, these consumer loans, are parents of banks, because Alibaba, just to explain again, so when when you buy something on Alibaba, you are offered a short-term consumer loan, maybe 30 days, no payment. And also the vendor is offered inventory finance. So both of you get finance. Therefore, money changes hands. Alibaba Group, the e-commerce site, makes money. So where does that money come from? So Ant Financial puts that money up first, but they don't want to have all these loans on their books. So what do? They package together thousands and tens of thousands of these micro loans, these tiny loan amounts, and they resell it on the interbank money market. So banks basically buy up these loans and they are bundled together according to different ratings. So Alibaba, through the data they have, gives them ratings and scores. So some of them are, AAA rated, if you will. Some of them are B rated, etc. And for that, obviously, interest rates and prices are then different when they resell it. And that means that Ant Financial has lent an absolute enormous sum of money while only putting up about 1.6% of their own capital. Now, a bank here in China typically puts up 25 or 30% of capital, and that's definitely a big change to the Ant Financial business model that's coming. So we already know that. So it says here it's difficult to completely separate the flow of the payment business from the financial business and the loans, and sort of establish a firewall between the two, because they're so interlinked. Because I make payment with my Alipay and I get an option for credit instantly. Now that credit should really be provided by a regulated sort of banking financial services company. It's essentially a credit card company. It's like a Visa or a MasterCard. So that will be that financial holding company. If you keep the tech side, the actual technology that handles that outside of it, you have to have some fairly complex agreements between the two. So that's, I think, really where Ant is probably scratching its head and looking at it from a technological point of view, from a legal point of view, and talking to the regulators and saying, where do we have to put that firewall? Can we keep this together? Can we have technology together with financial services? And so in the view of this lawyer here, Dong Yiqi, he says the payment system basically that Ant started with, the original or Alipay system, must be included in the financial control and must be regulated. So if you read between the lines, I think Ant or Alibaba would like that to be outside of the regulation so they can keep growing their tech side and their blockchain side that underpins that without the stringent oversight of a financial or an insurance regulator. So how to strengthen this here, blah, blah, blah. So let's look at here. Essentially, strengthening the supervision of Ant by the Chinese regulators is not only for anti-monopolistic purposes, but they're worried about a systemic financial risk. And we saw last year, Ant was basically declared a too big to fail organization that was systematically important to the financial system in China because of the scale it had reached. They operate with basically all of the financial institutions, provide loans through this platform on Alipay and work with Alipay and take payments that way. And they're literally trillions of renminbi of assets that have gone through this system. And therefore, this is of systematic importance. And what they're worried about is a consumer debt problem. So, and what they call these joint loans here, they are basically transferring risk off Ant's books into the wider world, into the banking world, and then it sits on everybody's book. Every financial institution in the country has these. So here's a banking commentator, industry veteran, said that the banking firms that cooperate with Ant for the retail loans have reached several hundred billion, significantly more than its management capability. And it's the front end of a boom in the case of this cash. But in the future, if there is a loan or a credit card crisis, a consumer loan crunch, it could be a big crisis or a big loss for both sides. So the concern is here, all these tens of thousands, millions of small microloans for people buying stuff on Alibaba Group's platforms, that has been repackaged, a bit like mortgage loans get repackaged and sold on. So if there is a problem with the payment of consumers, because perhaps this financial, economic situation worsens and people lose their jobs and are unable to pay for these, if you start seeing defaults in that loan portfolio of these millions of tiny loans, they are on the books of all the financial institutions. That could lead to a massive crash and a huge problem, financial crisis in the banking and financial services industry in China. And this is fundamentally why that IPO was stopped. I don't believe it's because they dislike Jack Ma. I mean, he might be a little bit too flamboyant for some people's taste, but fundamentally this is a credit risk situation here. So there's a little bit more to come. Let's quickly look at if there's some important questions here. Can you link the article, Michelle? Gladly. I can't do it on the live. I'll post it below in the comments, so do watch out for that. Gustavo, is it old news? Well, it's out today, so it depends on whether you read Chinese news this morning. Chelsea Woods here seems to be spamming us with some undoubtedly dodgy investment scheme. Why are you all talking old news? What happened to your heading, which is 51 billion fine? Radar, no, not clickbait. We covered that at the very beginning. You're very welcome to play this back. But basically, in short, under the anti-monopoly laws, this applies to the Alibaba Group investigation, this exclusion of other platforms, this sort of choose one out of two. The maximum fine they can hand out is 10% of revenue of the last financial year. As of 31st of March 2020, the revenue was 509 billion renminbi. So that therefore equates to 51 billion renminbi, something like 6.8 billion US dollars. That's the maximum fine, hence that headline. I will try and give you guys those articles that there are in Chinese. Do you think rate will suffice for sentiment change? Will this overhang? My view is that all this stuff will continue to overhang this stock until it is really resolved. More here from Chelsea Woods. I sadly don't seem to be able to kick her out, but that seems like a spam account, guys, so don't call her. I appreciate the 75 likes here, 207 of you joining us at the moment. So ask anything you want to ask. I answer everything as best as I can, and hit that thumbs up button. It helps me a great deal and it makes me very happy and encourages me to provide more information daily here from China on fintech, EVs, etc. So let's just go through this a little bit more. It's a little bit detailed, but I think it's important we understand this commentary from the financial sector and the legal sector here. Basically, it just sums up here this system, the way they've been lending money, putting in very little money, but loaning a great deal by using other people's money, repackaging it and reselling it. So that's how they get it off their books. So apparently, the rumor is that all of these unrelated joint loans, all of these consumer loans have been taken on by the central bank. So the rumor is that all of the financial institutions in China, all the banks who have these loans on their book, that these have been moved to the Chinese central bank. That isn't clear whether they have all of the loans or just some of them, and if there are parts which they're particularly concerned about. We covered in a previous video, we looked at the actual quality of the underlying loans, and they were investigated by the Chinese central bank, and we actually have the deputy governor of the Chinese central bank here say that there aren't any apparent problems with the underlying loan book. And remember, these loans are tiny. They might be $5, $10, $100 because people just order small things on Alibaba platforms every single day and they can defer payment essentially. So I think that's a big positive, that there doesn't seem to be a problem in the underlying loan book, because if there was a problem, that would be a huge issue, because it's a very big loan book and that could cause a sort of financial crisis. And that is perhaps why the central bank, and I'm speculating here, has taken all of these books, all of these loans of everyone's books and moved them onto their own, so they really know exactly what they are, and then they can see them getting repaid and they can regulate that for new loans, Alibaba needs to put up around that 30% capital, and undoubtedly the speed at which those loans come out will be slowed down. And that, in my view, is also the reason for the overhang on the Alibaba Group side, because that may well reduce transactions on Tmall and Taobao if there is less availability of consumer credit. We have already seen that the consumer credit available, especially to young people, has been cut about 90%. It's now around 300 RMB only, about $400 seems to be the maximum people can borrow without any kind of proof of income. Now that might still be considered a little bit too loose for some. Certainly that's part of the criticism that came out of this, was that students, school children, were able to borrow quite substantial sums essentially through this Alipay credit card, although it's of course a virtual credit card, if you will. There's no actual card or card number, and they were able to incur debts which they would struggle to repay. And it isn't really fair on them. It is not a good precedent, and it certainly isn't healthy for the financial economy here. So some banks apparently have suspended their cooperation with Ant's incremental business. This is this loaning business and then repackaging. And those who are still cooperating have increased their vigilance on this online joint loan business, because the money that's being put up is partly belonging to other financial institutions. Again, another way that Ant has managed to extract the need to put capital into it, and came up with a 58% gross margin, which anyone who follows financial institutions and stocks knows that that is not something that happens anywhere else in the world. So we basically know here it confirms that the new regulation on small online loans requires these joint loans to have a 30% actual capital contribution. So if Ant wishes to continue providing these loans to consumers to buy stuff on Alibaba platforms and possibly other platforms, now that this whole sort of slightly monopolistic behavior is being broken up, you might well see that JD is forced to accept Alipay, and that Alibaba is forced to accept WeChat Pay. So that's a different story, and perhaps be able to have other lenders on those platforms. But that's something a little bit down the road. They need to put up 30% of actual capital. So if they want to lend $1 billion, they need to put up 333 million. So that will cost them money. Now, it's not clear of how much of Ant's 2.1 trillion renminbi credit balance are joint loans and these kind of loans, but it's conservatively estimated that Ant needs to invest more than 100 billion yuan in order to maintain their stock, this kind of loan business. I think it might actually be quite a lot more than that. That 100 billion figure, I think, is quite a conservative number here. Let me just have a quick look if any of you have questions on this. Even the 51 billion find, we look at their growth rate and their cash flow, their bottom should be, if we look at the fundamentals, right up there. Yes, I did also say they have a $50 billion amount of cash in the bank. So even a fine of 6 or 7 billion US doesn't really hurt them that much. And if this happens very quickly, if there's a quick end to this, it could actually be a very positive outcome for this. Do I think it'll pull back again? I think there'll be strong volatility. But again, guys, I say this for entertainment purposes only. I'm required to say that. This is not financial advice. Franco in there, appreciate your views on clickbait. Well, I'm glad you guys have all joined and we can go through the details together. 214 of you here and 92% of you are happy with it so far. Apparently you gave me a thumbs up, so I really appreciate that. Joe Yuma, do you see Alibaba issuing a dividend in order to divest? I don't quite see how the dividend helps you to divest. I think long term we would expect a dividend from a business like Ant or Alibaba because they're very cash flow positive. But while they see growth opportunities by using their money to invest it into new businesses, and while that is permissible in this new regulatory framework, and certainly M&A will be harder and cross-subsidizing new parts of businesses will be harder, you can spend money on R&D for sure, developing new businesses, yes. Undercutting the competition, artificially lowering your prices for extended periods of time, no, I don't think you'll be able to do that anymore. So they need to look at their cash balance there. Alibaba Group has an exceptionally good free cash flow, so they could certainly issue dividends, but they want to be seen as a growth stock. Growth stocks, they tend not to issue dividends. That's just my 2 cents on it. Kevin Zero from us from the start. Do play it back, guys, or ask, and I'll do a quick sum up here. Do we think the delisting will cause panic selling, Joe, there? I think the institutions are out of these 3 telco stocks. We're going slightly off the subject here, but it is bad for the sentiment of the market, in my view. So I do expect that to cause us some volatility in the next year. Could this hurt Tencent and WeChat Pay? Everything that happens to Alibaba and in terms of this new regulatory framework also happens to Tencent, to JD, to WeChat Pay. So the capital requirements on the lending, the regulation on the financial holding companies, the insurance business, Tencent has all of those. JD is the most similar to Alibaba Group's e-commerce business. They've also been running these kind of give us exclusivity on offers type things. That applies to everybody. It's just that Alibaba is being singled out here as the number 1 player, 55% market share on the e-commerce business. But these guys, Tencent and everybody in this space, PDD, everybody, are watching very carefully what's happening here, and they will voluntarily implement these regulations. And I'm sure they're talking to the regulators to exactly understand what's going on here. So Mikhail there, thank you very much for that question. So let's just round up this article here. The shrinking of the Ant joint loan business, basically their consumer loan business, is a foregone conclusion, says this commentator here, the lawyer chap from Shanghai. If it's done under supervision and sufficient capital provision, 30%, then this will suppress this lending space. And the intention there is therefore to make it more expensive, also make it more expensive for consumers actually to borrow money, and therefore there'll be less risky lending. That's really the idea here, I think, to ramp down the amount of money that's being lent to consumers who possibly don't have the ability to repay, and there'll be a lot more regulatory oversight in exactly who Alipay or Ant are lending to. And I mean, they have all their credit score data from all the transactions, because everybody lives on Ali platforms. They know everything you buy, they know what you earn, what you drive, where you live, they know all of that data, and it's very powerful. And through the AI systems, they're able to exploit that in a positive way. I mean that in a positive sense. And they're sharing that data with the government through the credit rating agencies that they've been given a share of by the government, because the government wants that data because it's so valuable, and that blockchain technology, etc. And through that, the regulator will be able to look at the loan book, perhaps live, day by day, or weekly, or monthly, or quarterly, and set new limits and ceilings for the amounts, for the kind of people they can lend to, how much they can lend to them, the credit terms, the interest rates, and all these things. And that's quite frankly something the regulator simply hasn't looked at. In 10 years, no one's looked at this stuff. So it's all just coming to a crunch right now, and they are catching up. The Central Bank of China has also said that after they interviewed the Ant Group together with a bunch of other regulators, they were accusing them of defying regulatory compliance requirements. And I think they're actually right there. Ant was really sailing very, very close to the wind. And with some other things, really, they were taking the mickey, to put it politely. Illegal regulatory arbitrage. And they told them to fix basically 5 key steps here, including that holding company, and to have sufficient capital and basically be regulated like a bank and like an insurer. So that's the challenge here. It isn't just the regulation of these internet giants in terms of monopolistic behavior. Data security is a big issue, like how safe is all of this data? Normally one company, can't think of a single company around the world that has as much data on their citizens, if you will, as Alibaba. It's typically separated. It would be sort of a bit like combining maybe PayPal with Visa card, MasterCard, and Amazon, and lumping all that data together, and then having a great AI system to analyze it, and therefore you would really know what everybody is doing and earning, where they live, etc. So this regulatory framework will continue to evolve. That's what they're saying. They're saying that they need technology to do it. It'll cost some money, so that will get passed on, I imagine, to these fintech companies. And that's also the model in the US. The regulatory oversight burden cost is generally borne by those who are supervised. And the challenge really the government has is they don't have the experts on it. The fintech experts work for people like Alibaba and Tencent. They are not in the central bank. They haven't got these kind of engineers that actually understand this process in detail. So I think another thing you might see here, I think we might see some tech departures moving to or being loaned to, or in some sort of frame, bringing the regulatory bodies up to speed in terms of technology and a thorough understanding of how this works. So that's, I think, that roundup there. So let's summarize that very quickly. The maximum fine Alibaba can face under the law for its anti-monopolistic behavior, and this is Alibaba Group specifically, BABA, is 51 billion renminbi. That's about 6.8 billion US dollars. That's the maximum they can get fined under the law, as it's 10% of last year's revenue. The second part here, what I described as takeover, is really that the loan book appears to have been taken from all the financial institutions who hold these repackaged microloans that originate from Alibaba. It appears to have been moved to the Chinese central bank, and they're looking at that very, very closely. And definitely the lending business, the money market fund, the largest in the world that's part of, and the insurance business are going into that financial holding company that's been set up. There seems to be a struggle to possibly keep the Alibaba technology side, the platform side, outside of that regulation, so that the technology can evolve quicker without having to ask for permission from the banking, insurance, and other financial regulators here. Very difficult to separate that because those are so intertwined. So I would expect, and this is my personal view only, all of the lot basically to go in there, and possibly we might see some of the insurance business being split out into new subsidiaries so that the regulation that's coming in there will apply just to insurance. Because typically, if you look at the world, insurance companies that actually issue insurance tend not to be the investing fund side, and typically have separate companies that handle their holdings and their investments. So guys, a couple of questions here. I appreciate those. I personally feel we should sell our holdings if they start passing regulations on their cloud business. That should make us panic. Your opinion, Felix? I don't want to make you panic. I think the cloud business is a very positive story. The expectation is that it might go positive in terms of net earnings in Q1. We've also heard the regulator last week say, and we went through that in a previous video, so do binge on my Alibaba playlist there for all the background to this. They were saying that they thought the cloud business was a very positive part to the growth story of the Chinese economy. They want all of the major traditional companies to be powered by this cloud software and blockchain technology, and they're encouraging that. So there was a concern that possibly this cross-subsidization from Alibaba Group's cash flow, if you will, into the cloud business could potentially also bring a monopolistic accusation with it, because they've been subsidizing that business. Therefore, they've been selling the service below cost. One could interpret it as that. But as they're at their almost break-even point, and these positive words we've had from the regulators that they actually value that technology, they want that to continue to power the Chinese economic growth. I would be very surprised if we see a negative reaction there. Though in terms of data safety, I do expect that there will be more regulation forthcoming. But then, guys, this is just something that you have in the US, you have it in Europe, in the UK. Every developed economy actually has these regulations. It's just here it's all coming at the same time. It comes with this big bang story of the largest IPO being delisted. And it comes in the current light the world sheds on anything that's Chinese news. It tends not to put it in a very positive perspective. You think this is a buying opportunity? Fair enough there, Mikhail. Thanks for asking. Since 99 trades in Hong Kong first, Bower prices trend normally to follow 998 later the day, Ivan. A very good question. So Alibaba Group is dual listed. In Hong Kong, it's 9988, that very fortuitous number. And in New York, of course, it's BABA. Hong Kong, in terms of time zone, is at present 13 hours ahead. Sometimes it's 12 hours, depends on the daylight saving of New York. So when the Hong Kong exchange closes substantially down, you essentially see New York in pre-market trading going down. Why? Well, otherwise you'd have an arbitrage opportunity there. You could buy in one, sell in the other, and you'd make a great deal of money. So generally free markets don't allow that. So yes, I think there is a connection between end days. And the same happens the other way around. When New York closes down, say, the next morning in pre-trading, Hong Kong also tends to be down as the stocks movement sinks, as they are both investments essentially in the same company, though through slightly different legal methods. What about companies where Baba's invested? Do you think this will have side effects like Xpeng? Alibaba is an investor, I think, in the last 3 rounds into Xpeng, together with some pretty significant international investors. Alibaba has lots of investments. We have seen that Ant is divesting some that are non-core, or at least moving them into another entity so that they are not covered by the financial regulation that's coming. And again, that was something you would expect. You wouldn't expect an insurance company to hold equity investments directly in the same company, or they might spin them off to some other private equity buyers. There's some pretty juicy stuff in there, like Didi, for example, that would actually allow them to raise capital if they wanted to that way, and use that as the capital requirement for their ongoing loan business. Xpeng, I don't think there is this negative knock-on effect to everything. We have seen in the last week or so new joint ventures of Alibaba's with state-owned enterprises like SAIC, that massive car manufacturer. We've seen them sign cooperation agreements with local governments. So they are not this pariah, this outcast that some media describe them to be. It is somewhat business as usual. It's just that there is this whole restructuring going on, especially on the Ant side, on the financial side. Mikhail, has the regulator executed the fine? No, not yet. We are waiting for that news. We are waiting for when that happens and the exact amount of it. This is the maximum they can fine. I wouldn't be surprised if they do find that they find the maximum, because they want to set a clear precedent here, and Alibaba certainly has the cash to pay it. Norina, thanks for that question. Thanks for joining. The quick resolution of the monopoly situation, it's not so terrible. The fines, the fact the company is so cheap right now, spells super great deal. I took big hit, but it'll be back up. Positive view there, positive long-term view. I appreciate that. Is this all priced in? Well, I mean, I think the trouble here really is this ongoing negative news cycle we've had on the Alibaba stock really since November. The delisting of these 3 China telcos is just sort of more icing on the cake of bad news that surrounds Alibaba, and bad sentiment and uncertainty. And that's what we have really here with the Alibaba business. We have uncertainty as to exactly how the structure looks. We have the uncertainty of exactly how much they can lend and how much a lending reduction will hurt the e-commerce turnover, which powers Alibaba Group's revenue, because the only thing that's profitable really in that group are the e-commerce platforms at present, until cloud comes along. So that's really the roundup here, guys. 51 billion, price will drop 30%. I mean, I can't give you that sort of prediction. I almost think that a quick fine might almost be a relief here. But as always, I say this for entertainment purposes, not as financial advice. So guys, bear that in mind. So quick roundup here. Maximum fine Alibaba could get for their anti-monopolistic behaviour on their e-commerce platforms is 10% of last year's revenue. That is 51 billion renminbi, or about $6.8 billion US. And then secondly, we looked at in quite a lot of detail at Ant. So if you've just joined, I'll put it online. You can replay it. You can replay it now. Also, we looked at that their loan book is being moved into the central bank. We are looking at this much more closely. We know there's going to be a capital requirement of 30% coming, and we are wondering whether the Alipay tech side will be able to stay outside of this new financial holding company, or whether the tech business of that fintech's business will also be regulated like the banking and insurance business, in which case it would make it a little harder for them to innovate, whereas if it's outside of that regulation, if they can somehow sever those ties and run a pure tech company in addition to the banking insurance company, there might be some advantage in that. So guys, that's really the wrap here. I really appreciate you guys joining. 120 likes, 200 concurrent viewers. I appreciate your support. Smash that like button, guys. It makes me very happy. And I'll keep you covered on Alibaba and what happens here every time there's breaking news live here from Hong Kong, China. And I'll put out also summary videos of these things daily. You see, I cover this space, EV, and anything exciting that happens to do with China, especially from a hopefully non-biased, non-politicalized sort of news point of view. So guys, thanks for tuning in. I appreciate your likes more than anything. Thanks to everyone who was waiting. Thanks for all your questions and comments. If I've missed anything after this, post a comment in the video below and I will answer as best I can. So thanks very much there, everybody, for joining, and that's a wrap.